The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. If you have any questions, it's 877-927-6648. And I think we should start out the day by looking at the U.S. dollar. We have completed that big AB equals CD level up at the 84 level in the U.S. dollar. That equates to what we're looking at in the euro on last Wednesday when we were watching it down at the 121.60 level. That was the 1.27 expansion off of the full moon and solar eclipse of June 4th. And so we should be in a rally mode, at least for a few days in the euro. Longer term, it has much, much lower, targets, but, the markets get oversold, and we are certainly experiencing that. We need the U.S. dollar index to substantially close above 84. And with the preponderance of the weight in the dollar index is, the euro, which is more than 53% of the index in the U.S. dollar. That's what you would be looking for. So, the other currencies, the Aussie and Canadian and others, are very important, but they don't have the same weighting in the index. So it's sort of a bias index to the euro. But we should get a pretty good rally, I would think, at least up into that level where we broke down from, potentially up into that 124 area, which is where we broke down from at the 786 that we had talked about, several times. Now, we also need to talk about the bond market today because bonds were really telling you something on Friday. With the stock market up 200 Dow points, the breadth was 4-1. In other words, there were 4 advancing issues for each declining issue, and it was accompanied by up volume, down volume statistics that were incredibly bullish too. Bonds actually closed higher on the day. I was absolutely shocked when I got the figures, but I said, uh-oh, this is a problem. And of course today, the bonds are a little bit stronger. And in fact, they're quite a bit. They're up about a point, and the TBT broke down, and so it looks like TBT is going to go somewhere into the 13 level, would be my guess. So I'm not sure what's happening. All I know is that I'm wrong now, and I'm not going to fight this puppy. Hopefully, I'm not going to get these bonds to 160, where I have to go out and ride on Tom's boat. But we'll have to wait and see if that occurs. But my only prayers that I say every night now is, please don't let them get the 160. 159.5 I can handle. But that's what we're watching. I think that we have a really good chance of making this final move up into the 3rd of August, which is the full moon. We have the new moon coming in on the 19th of July. That's on Thursday of this week. And if we can move down just a little bit into the 19th, nothing dramatic, but just a little quiet move down into the 19th, to sort of, take care of some of this power that we had on last Friday, and then have one more move up, then what we need to do is to get it up into August 3rd, and I think that will be the one that will be the one that you want to look at. Now, folks, we look at the Bradley model quite a bit, and we've seen the Bradley model a lot of times, but I wanted to show you, what the Bradley model did in 2007. Because as the market was making a new high at that time, which was in October of 2007, the Bradley model was starting to point down, and it pointed down all the way through 2009. Now realize this Bradley model does not have a PhD in economics. It doesn't go to Princeton. It doesn't go to Harvard. All it does is it looks at numbers of cycles. But this is what we have coming up in the Bradley model on August, between the end of July, around the 30th, to August 3rd. We're expecting this model to turn down, and it stays down for 9 months. And what that means is that the market will have a negative bias if it follows the pattern that it's been following. And so this is what we're waiting for, is to follow this move on August the 3rd. I think we're going to just be choppy to upward. been saying that since the 6th of June. So that's what's been occurring, and I think that we have a chance to get one more move. Whether we make a spectacular move up in some of these things, I'm not sure. But we've had a big move in the utilities. It's it's near all-time highs, and that's something that we need to keep on the four burners, because if the utilities keep making new highs, it's telling you that the people are either fighting for interest rates in the utilities, or the utilities are consuming so much income by providing electrical power to our manufacturing. And my assumption is that it's more or less a fight for dividend yield, because we have negative yields in France. We're at under 1.5 in the 10-year now in the United States, and the 30-year is at 2.7, and so these are very, very low rates. And that's the importance of the things that we're watching. Now, I want to put out a little table that was published by Peter Brandt. Peter Brandt has been around the commodity markets for many, many years, and all financial markets. He actually worked at Conti Commodity at one time, and he put out a little table on asset class. And it shows the daily trading volume in these different things that we look at. And this is going back to 2010. I don't think it's changed too much since that time. It might have increased or decreased a little bit, but I think that the figures on a ratio basis are very, very important. And you'll see that the Forex market trades at $3.9 trillion per day, as opposed to the S&P futures at $120 billion, the New York Stock Exchange at $48 billion. And the difference there between the New York Stock Exchange and the S&P futures is the margin, because you use 90% margin on those futures, and that's why it's such a big different day. Now, the Bradley model that I posted into the Tiger TV was the one for 2007. When we come back from the break, I'm going to put in the one for 2012 and show you how the correlation has been. It's been actually quite well, but right now I want to get back to this asset class thing, because it's very important. You can see, where T-bond futures are and gold futures and the NASDAQ. But the bottom one is the one that's most important, and these are the CDS, or credit default swaps. And these are tied to corporate bonds. These are relatively new derivative. They're, I think, less than 10 years old. And you'll notice they're at $11 trillion. Well, $11 trillion in itself is a huge number, because it's 3 times bigger than the one for Forex, which I thought was the largest market in the world. But if you'll notice, I circled the OTC under the credit default swaps. That OTC stands for over-the-counter. And that means the over-the-counter things are not traded on any exchange. And what happened? Well, they're traded on an over-the-counter exchange, but the liquidity on these things is absolutely horrendous. And this is what's happened to J.P. Morgan. They got involved in something that they couldn't get out of, and they got trapped. This happened to Long-Term Capital back in 2000, I believe, when they had all those Nobel Prize laureates in economics, and they went under. And the same thing is happening with some of these other things. Now, J.P. Morgan came out Friday, and they said that before it was $2 billion, and then they said it was $5.3 billion, and now they came out today and said it was closer to $7.3 billion, and my guess is it'll be closer to $11 billion before it's all over. The ironic part of what happened Friday is, I'm going to have to be embarrassed to tell you this, but I listened to Jamie Dimon, because he doesn't come on to a earnings thing like he had. It was very rare, and it was handled like a rock star concert. If any of you folks watched it on Bloomberg or CNBC, I wanted to see it just for the the paparazzi and all the stuff that was going on. But I listened to Jamie Dimon. I've been in this business 55 years, and I swear to God, I did not understand what that man was saying. And I felt really badly until 2 or 3 hours later, I got phone calls from some of my other friends on Wall Street and said, "Do you understand what that guy said?" And I said, "No, I did not. I understand little tiny bits and pieces of it, but it was like Greenspan talking. I could understand what Greenspan was saying, and I couldn't understand what Jamie Dimon was saying. I understand about getting shot in the foot. That much I know. I've done that myself. But what he was trying to explain was done in such a poor manner that I don't think anybody could benefit of understanding it, and especially these financial analysts that are supposed to be on top of this. And so this is the environment that we're in, folks. I've said this since August the 15th of 2007 when we broke those lows. I believe that we are in a market that is similar to the panic of 1837. It's a 170-year cycle. That lines us up right now. It usually lasts 10 years. That's what happened in 1837, but everything's different now because of the communication and all the things that we have going on. But it's a debt cycle. What they're doing is they're adding more debt to take care of the debt that they have. In other words, if they have short-term debt, all they're doing is adding long-term debt to it. And that's not the way you fix things, in my opinion. But right now, the world is telling us that they don't want to worry about, the interest rates. They're interested in the safety of their money. And so what they're doing is they're putting their money into Treasury bonds at an alarming rate. I'm going to show you the inverse government bond strategy. In other words, for putting money into, long-term yields, and you'll see that over since 1999, we've made a huge AB equals CD pattern, whereas, in other words, people that are putting these money into these long-term bonds, it's really not the thing to do, folks. You're lending money at 2.7% for 30 years, and frankly, that is not what I think is going to be what I call a dream trade. I think it'll be more of a dream trade, but the dream will be more than a nightmare. Now, there's a possibility that I've made a bad mistake in this, and I'm just going to to bring out something that happened going back 20 some years in Japan. You'll see that the Japanese interest rates have been at zero since 1995. Now, their economy is totally different than ours because it's a small island. They import a lot of things, and they have a declining population and a very aging population, which is totally different than ours, and they don't consume nearly as much as we do. So even though it's the third largest economy in the world, it might be fourth now after Germany, but it still has a different type of demographics than we have in the United States. But needless to say, we still have had over the past 3.5 years, since we had the meltdown, interest rates have basically been at zero. And as you can see, in 2007, we had interest rates up around 5%, when the market was going crazy and going up into October. And then when the proverbial stuff hit the fan, interest rates dropped to zero as everyone made a flight to safety. Now, long term, this says this should change, but right now this has not occurred. So we're just biding our time. And since we're biding our time, we'll be able to take a nice commercial break here to pay for some bills. 877-927-6648.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold.
Your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes a carefully selected portfolio can lower your volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angelo O'Brien, financial advisor and certified financial planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks. If you have any questions, it's 877-927-6648. Okay, the next thing I want to talk about is the problem that's going on with not only MF Global, but also with PFG Best. It appears that Mr. Wassendorf left a 3-page suicide note where he basically described everything that he did. That's amazing to me. Usually suicide notes say, I'm sorry, good luck, or whatever. And but anyway, this was a very long one. This story is far from over, folks. He was on one of the committees for the CFTC. They're now saying that there might be some collusion with people at the CFTC, which wouldn't surprise me, because if you have someone like John Corzine, who was in politics very heavily, steal all the money and nothing's happened to him, we have major problems with cover-ups and all the other stuff. And this LIBOR thing that's going on is absolutely, just totally amazing to me that the people were that, unbelievably narcissistic that they could get away, with something like that. I mean, this is just, this affects everybody, the LIBOR rate. That's the London Interbank Offered Rate. And that affects, your credit cards, your house payments, your car payments, everything that we use credit for is based on that rate. and it's it's very, very, very bad. That's what's happening there. So, and it's far from over, and I'm sure there's going to be a lot of cover-ups. But this is what we're going through, because we are in a cycle that I think is very similar to 1837. And we're going to, as we come into this August 3rd date, we're going to be able to take a look at it. Now, I wanted to talk to you about the risk that you take when you're dealing with these commodities, and also stocks and Forex and stuff like that. I put a thing into the Tiger Den in Tiger TV about trading philosophy, and it talks about the 3 types of risk that we have in the market. One is the market risk. These are factors that are unknown. The government reports, weather and, liquidity and government reports are they really following what people are doing? There's also a systemic risk, and that's part of the problem that we're going through now, is that the Chicago Mercantile Exchange is broken down. They were the house of last resort. They no longer stand behind what they're doing. So the only thing you can do now is to hope that you pick someone that has the absolute mental facility and the strong background to be honest and do the right thing. And so the first thing you want to do is to try to know who you're doing business with, and also make sure that they're a clearing member of the Chicago Mercantile Exchange. If you're dealing with a listed company, that's a little bit better, because MF Global was a listed company, and that stock had started going down, and then it dropped precipitously as it went in to bankruptcy. I'm sure they've lost the money in speculation, whereas in the PFG Best, that money was used to, just fund a man's dream with his private jet and his charities and stuff that he was using, and it looks like he finally got caught. And folks, that really shocks me, because I knew the dude and I knew his son, and it really put me back on my heels as far as wondering about why he would actually do something on that. And it really is something that sort of scares me, but in fact it's part of our business, and there might be 1 or 2 more of these out here. I'm not really sure, because after this it really makes me wonder. And I'm very concerned about it. And people that ask me, where do they keep their money? And frankly, I think the best place, if you're trading, is a big company like Ameritrade or Scottrade or Interactive Brokers. I know sometimes their platforms is not as good as other, but I'm pretty sure your money is safer there than most places. If you're trading at the Chicago Mercantile Exchange, make sure you pick a clearing member. Somebody like R.J. O'Brien or ADM, Archer Daniels Midland. It's a privately held company, but it's one of the larger ones, one of the larger grain companies in the world. It's been well run, and usually you'll be okay. Stay away from the small firms, folks. You don't want to be anywhere near those small firms, and especially if they're clearing members. Now, when you go to Forex is a different story. You have to pick a big Forex bank, one that's very heavily capitalized, and that's what you want to do. But a lot of these little Forex firms are, run out of basements and stuff like that, and you want to be careful that you don't get caught up in that, because they are not regulated by anybody. So that's something that's very, very important. I just realized that ADM is publicly traded. I was thinking of somebody else. Conti Commodity was not regulated. Okay, I'm sorry. We've got to take a little break here. 877-927-6648 if you have any questions.
Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his Market Take and provides trade recommendations, including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, we're back. 877-927-6648, and we're going to be talking a little bit about the Bradley model one more time. I know it gets old for some of you, but it doesn't get old for me. And since it's my show, this is what we're going to do. As you can see, if you go into Tiger TV, we have a very, very strong trend-changing date coming in late July, early August, and with the full moon of August the 3rd, my expectations is if the market is making a high at that time, this is where we'll be expecting it to roll over. Now, there is a possibility that we can go sideways here and not take out the highs of the full moon of July the 3rd. If that happens, and we do not take out the high of the full moon of July 3rd when we get to August 3rd, that means over a 30-day period, the cycle has been turning down. We will have lower tops. We had a top back on the full moon in late April, and then we had the other one on July the 3rd, And if the one comes in on August the 3rd, now we're a long way from there because we have, 2.5 more weeks, actually 3 weeks of trading before we get to that point. So we've got 15 trading days, and a lot can happen in 15 days. And no one can predict what's going to happen. But if we do make a lower top in there than we did on July 3rd, this is going to be incredibly bearish. Now, my assumption is that we're going to go up, and we might even test the highs that we made in April in the Dow Jones Industrial Average and maybe some of the others also. But we've got to get moving, really rather dramatically here in order for that to happen. We did have a really big up day on Friday, and it was accompanied by 4-to-1 volume, and it was advanced declines were very good, and so that tells us that the market does want to go a little bit higher. Right now, I think we're just digesting some of those gains, but we'll see if we can keep moving higher or sideways into that August 3rd full moon. I think that's the one that is going to be actually the most important that we're going to have here, in quite some time. That's the assumption that I'm looking at. Now, I want to get back to the bonds for just a little bit here because the Treasury note market, which is the shorter-term market that we've had, has now gone and made a higher high than it made in May. That tells us that interest rates are still going lower. That sets up about another point higher in to the Treasury note. It would be making a butterfly pattern up into that time zone that we're looking at here between the 19th of July and August the 3rd. This is I'm still very bearish this, and I will get on board. I'm going to keep nibbling at it till I get it right. But frankly, right now, it looks like these things want to go just a tad higher. And so what I have to think is that if we do get there, we'll take another nibble at it at that time. The TBT has gone into new low ground, so that sets up a 1.27 expansion of that particular ETF. And whether it's going to be the ultimate bottom or not, we'll just have to just examine it when it gets to that spot. That's the only thing we can do. I was surprised that we got above this last level, but in fact it did, and there's nothing else that we can actually do to prevent that because we don't know which ones are going to work and which ones aren't. We got a call from Mike. Are you there, Mike?
Yeah, good morning, Larry. Appreciate your thoughts on everything, the markets and all this other stuff with the futures accounts and so forth. Really appreciate it. I share your view of the markets, but I just have one question that it seems to nag at the back of my mind here. If the markets do turn down, as we expect, why wouldn't the bonds break out and go to 160 or more?
Oh, they certainly could. That's the possibility that does exist. I looked at the long-term interest rate pictures in Japan and what happened there, and that's a possibility that could occur. That doesn't mean they're going to stay there. And remember, it's a matter of perception. This is what these markets are about. If you ever watched that movie, the first Wall Street film with Michael Douglas, where he talked about fear and greed and perception becoming real. And this is what happens when people perceive something happening. Like everybody perceived that China was going to have a 10 or 12% GDP forever. And now they're barely holding 7%, and we don't even know if that figure is correct. So it's the perception of what's happening. Another example, Mike, is the fact that look what's happening in Greece. We don't even hear about Greece anymore.
No.
Yeah, it's just
it's all better now.
Yeah, everything is better now, and in fact, we believe that it's not. Frankly, I think the thing that is most alarming to me is two things. One is the fact that nothing's happened with MF Global. There should be people in jail for this. And the second thing is this LIBOR thing is huge. This goes to the heart of every country in the world, and nothing. I doubt if anybody will go to jail.
It's incredible, Larry. And you know, the talking heads on CNBC when the LIBOR came out, Michelle Caruso and the rest of them, they were like, well, what's the big deal? The central banks manipulate the rates all the time. It's like, my God, what have we come to here?
Well, the central banks have actually the right to do that. The traders don't.
Yeah, I know it. It seems, I mean, the world is upside down, it seems. And maybe I know Tom had Bart Chilton on, so maybe we give him a call. I always wondered how a bureaucrat could have time to hawk a book, but maybe we could get him to hawk his book and comment on Peregrine and why he wasn't out doing his job. You know, he's out there hawking a book, a bureaucrat, and people are losing hundreds of millions of dollars. I mean, it's just...
Well, it's really sad, and it goes to the fact that you know, I've said all along, and I get up on my soapbox, but this reminds me of what's happened from 1837. If you folks have a chance to go to Google, type in the Panic of 1837, and you'll see, you know, all of the things that happened to the destruction of our banking system at that time, and it was just massive corruption and fraud, much like we're going through now, and we're only seeing the tip of it. You know,
I saw a comment by Nouriel Roubini talking about, not my French history isn't that well, but talking about one of their French finance ministers, probably about the same time, 1700s, and they beheaded him for fixing rates. So maybe these folks want to hunker down. Yeah. Because, I mean, you know, you're right about the LIBOR rate. I mean, it was, you know, our home mortgages, everything was tied to it. And the fact that, you know, that this is just being, you know, I mean, it's just incredible. And this past weekend, what are they talking about? You know, on the talking heads, you know, about Mitt Romney's, you know, jet ski and blah blah blah. It's gross.
Well, and I'm afraid that we're going to be looking at, you know, many months of the mudslinging that's going to be going on in politics like we always have. But that's why I try not to listen to the news. I just try to look at the patterns. And, you know, at least it keeps my sanity after all these years. Right. You know, so that's the...
Well, the bond market seems insane to me, but it's doing its thing. So.
Well, the bond market is a bubble. I don't believe there's any question to that. I put the 30-year chart, you know, on. The fact is, I will do that again just for the reference of people that have not seen it before. But I will put that long-term bond chart on here because, you know, it's really a bubble. And in fact, I will show you the reverse of it, of what interest rates have done going back to 1800. And, you know, we're at levels that we've never seen before, even worse than the Depression. And so, I think we are going into a depression. You know, I don't like to use the D word. I used it with my daughter over the weekend, and she is 45 years old, and she started to cry. And you know, and I said, "Honey," I said, "you weren't even alive during the next depression." She said, "Yeah, but I can remember my mom, you know, telling her about it when she was only 6 years old." So she remembered a little bit. But these rates have.
I was going to say what's perverse too is that you know, what folks need to remember in short history on QE 1 and 2. The bonds actually fell. So, you know, maybe, you know, I always thought maybe Ben's got to come in with QE to support the bond market from crashing and, you know, to be there to support it.
I don't think anybody has enough power to outlast the actual supply-demand of what happens because this is my opinion, and I could be wrong, and I'm wrong a lot. I believe Bernanke has played, you know, his last hand of poker. And he's come in and made a very bad mistake, and he thinks he can correct it, but frankly, I think the market is too big. It could be China, it could be Japan, where someone says, "Look, we're tired of this. We're just not going to take any more of this debt." And who are we going to sell it to, and where are they going to get out of it at? You know, that's the problem.
I know. And isn't it? I got to just comment on it. And isn't it amusing? All the politicians on both sides of the aisle all upset that China was making the uniforms for the Olympics, yet China has financed all of our retirements and all of their programs for the last 50, 60 years.
Oh,
yeah. What's more important? You know, I mean, my God. You know, but Larry, we thank you.
Well, thanks a lot thanks for calling in, Mike. I certainly appreciate it. Yeah, well, there's no question that we have a lot of problems in our bond market, but let's talk about something that glitters, and that's gold. And, the gold market has now we've had 4 higher bottoms here since late June. Late May and early June, and we just completed another one down here at this 1555 level. We've had a nice rally. As long as we can stay above 1555 in the gold, I think we've got a chance, for higher prices to come in. It looks like everything is moving in the right direction. At least so far, we've had some follow through. So gold still looks okay. But folks, if gold ever gets below 1522, the cat's going to be out of the bag, and we're not going to have higher gold prices. But if we can get gold above around 1630 now, which is only $50 away, gold has a chance to be breaking out to the upside because it's had a long consolidation since the highs we made last spring. From we went down from 1932 per ounce down to 1522 per ounce, and that 1522 per ounce in gold was an exact 61% retracement of the July low of 2011. And so this is a very, very important spot to be watching under anybody's technical viewpoint, that's for sure. Now, I would like to talk a little bit about the corn market because, we're in the midst of a drought like we've never seen before. I'll cover more of this on the Commodity Show on Thursday, of course, because we've had, tremendous moves in these things. And, corn has made a 1.618 expansion now up to the 1778 level. And, we mentioned that once it went above that 17, talking about soybeans. Once we went above that 750 level in corn, that's set up for another move. But, the weather is still bad. What little rain they got really didn't help very much. And so this affects us down the road, folks, because as the corn goes higher in price, the farmers do not feed their cattle and hogs as much. They take them to the market because it's cheaper to sell them than it is to feed them, and that means that their herds are down quite a bit. And so when they tried to build up their herds and hold the beef and pork and chicken back, it's going to be very expensive for meat down the road. We're talking, lead time here somewhere around 8 or 9 months, I believe. Rich Anderson from Anderson Capital Management could give us some better ideas in that. But as I recall, it's around 8 or 9 months, or possibly a little bit more for a lead time, to build these herds up. So what's happening to us is going to, in the Midwest, affects us all. There's no question about it. We're having a horrible drought, nothing like we've seen since 1974, and again in 1978 and 1988. Now, remember in 1974 we had one of the worst droughts ever, and it was during the time when we had the Russian grain robbery, when Russia was buying all of our crops. But then right after that, in 1974, the prices of the grains collapsed and went down, better than 40%. And stayed down for several years. So even though these look bad right now, the crops could come back, but it still affects the cattle market and the hog market and the chicken market, because chicken is basically nothing more than recycled corn and soybean meal. And so these are the things that we're looking at as far as the commodities, because we're all interrelated to this. There's no question about it. And it's just a question of whether we're going to be able to, get through this drought and, maintain our sanity, because we really try to, we support the world with our food. And this is, wars are only fought for 2 reasons, folks: power and food. And, this is something that's relatively important. Okay, get back to the precious metals now. I wanted to let you know that we have made a triple bottom in the silver market at that $25.87 or $26 per ounce, and as long as it can hold above that, we've got a really good chance for it to go higher. Okay, we're going to take a little break here, and we'll be right back.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I think what we'll do is we will keep an eye on the thorn in my side. We'll take a look at the TBT here. Just on a little bit longer term basis, and it looks like we're going to get down to about that 1430 level, which is a 1.27 expansion. It would also be a butterfly pattern. The question is how much higher the bonds are going to be, at that point. You have to respect a market like bonds. When you have a huge move up in stocks, and bonds could not go down because that's usually the safe haven flight to quality story that we hear all along. believe me when I say what they tell us and what they're doing over in Europe and also in the United States and Asia is not necessarily what's going on. It takes a long time for these stories to get out, but they have self-serving interest, and with the lobbyists that we have now, heaven only knows, some of the deals that are being made, behind closed doors. You can use Goldman Sachs as an example because, when Goldman Sachs got into a lot of trouble, instead of, being, convicted of some of the things that they should have been convicted of, like rigging the oil market and a few other things, they paid huge fines of $500 million, $500 million. I mean, where does that money go, folks? I mean, it doesn't go to charities, that's for sure. I guess it goes back to run the corrupt organizations that are there. Frankly, I don't see how they can keep Gary Gensler on as the CFTC chairman much more because of what's happened to MF Global and then also what's now happening at PFG Best. And if they find out that there's collusion within the CFTC that allowed him to get away with what he did, then there's going to be some really strong ramifications in our political system. Frankly, when the CFTC comes to your house, the NFA, and to your office, I mean, they bring 3 people, they stay 4 or 5 days, and I'm just a single person, and it's just, and I have some licenses. I've never had a, complaint against me at all. They always fine me for $100 for not having the right paper signed in the right way or something like that, but $100 is the most I've ever had to pay. But to have someone there for that many days with just one person, why can't they send some people to Cedar Falls, Iowa, and check out an operation that's 3 stories and has 250 employees? My cafeteria it amounts to a wood burning stove and a pump coming from my cistern. So this is a totally different idea than what's going on. There's going to be more of this happening, so just be careful. I've had a lot of people ask me where they should put their money, and I can't make any recommendations, but all I'm saying is make sure it's a clearing member if it's in the Merc. Try to get it to be a listed stock company. That's another thing that you can do. And if you see anything that could possibly be wrong, pull your money out as quickly as possible. And also, leave the minimum amount that you need to trade. Don't have extra margin in there if you don't need it. I mean, keep it right at the bare minimums. If you get a margin call, either throw a few more bucks in to answer the call, or just liquidate down, to the sleeping point. That's the way I think I would handle it. From this, I never thought in my 55-year career that this would happen. I always thought the Merc was the pillar of last resort, and they are certainly not that anymore. They've already proven that. And so we have to be extremely careful. And there's another thing that we have to be careful about, too, is we've had these tremendous moves in these grains. Oil, soybean oil didn't move too much, but soybean meal, corn and wheat and soybeans have all moved. And if these things come down and these hedge funds are in the wrong way, look out, Gertrude. Anyway, everybody have a wonderful day, and may God bless.
Great Basin